put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The $120 billion printer that never stops. In a glass tower in Hong Kong, a printer hums in the darkness. Every few seconds, another $1 billion materializes into existence. Not from a central bank, not from a government mint, from a company that has never been audited, a company that claims to hold dollars for every digital token it creates, yet refuses to prove those dollars exist. This is Tether, a stablecoin worth over $120 billion, backing nearly every cryptocurrency transaction on Earth. And somewhere in the Caribbean, in bank accounts no regulator can touch, lies either the largest reserve of dollars ever assembled by a private company, or the most elaborate financial fiction ever constructed. The difference between these two possibilities is the difference between stability and catastrophe, and nobody knows which one is true. The year is 2014. Bitcoin is still a fringe experiment, dismissed by most of Wall Street as digital fool's gold. But in the shadows of the financial world, a problem is emerging that threatens to strangle the entire cryptocurrency ecosystem before it can grow. Banks won't touch crypto companies. Regulators view digital currencies with suspicion and hostility. And traders desperate to move between cryptocurrencies and traditional dollars find themselves trapped in a system that moves at the speed of traditional banking, painfully slow, heavily regulated, and increasingly hostile to their business. Into this void steps a solution so elegant it seems almost too good to be true. A new digital token called Tether, abbreviated USTD, promises to solve the banking problem entirely. The concept is beautifully simple. For every Tether token created, the company claims to hold one real US dollar in reserve. It's a digital dollar, moving at the speed of blockchain technology, free from the constraints of traditional banking. Traders can convert their Bitcoin to Tether in seconds, park their value safely while they wait for the next opportunity, then jump back into the market without ever touching a bank account. The promise is printed on every page of Tether's early website. Every Tether is always backed one-to-one by traditional currency held in our reserves. The company behind this innovation operates from the shadows. Tether Limited is registered in Hong Kong, but its operations span the globe. Servers in multiple jurisdictions, bank accounts scattered across continents, executives who rarely appear in public and never submit to interviews. The leadership reads like a cast from a financial thriller. There's Brock Pierce, a former child actor, turned cryptocurrency evangelist with a taste for elaborate costumes and a history that includes questions about his involvement with a company accused of inappropriate behavior with minors. Questions he has always denied. There's Reeve Collins, the marketing mind who helps craft Tether's image of stability and transparency, while revealing almost nothing about its actual operations. And lurking behind them is a connection to another company, a cryptocurrency exchange called Bitfinex that will prove far more important than anyone initially realizes. At first, Tether is a minor player, a convenience tool for serious traders who understand the risks. But as Bitcoin's price begins its meteoric rise in 2015 and 2016, Tether's usefulness becomes apparent to everyone in the market. Exchanges desperate for banking relationships embrace Tether as a solution. Traders use it to move value between exchanges without waiting for wire transfers. And slowly, quietly, Tether begins printing more tokens. Millions become tens of millions. Tens of millions become hundreds of millions. Each new Tether created requires, according to the company's promises, an additional dollar sitting in their reserves. But nobody outside the company ever sees these reserves. Nobody audits them. Nobody can confirm they actually exist. The first cracks appear in 2017 as Bitcoin surges toward $20,000 and the entire cryptocurrency market explodes into mainstream consciousness. A document surfaces online, allegedly an internal communication from Tether's banking partner. It suggests the promised one-to-one backing might not be quite so solid as advertised. Tether dismisses it as fake, but the questions begin to multiply. Journalists start investigating. They discover that Tether and Bitfinex, one of the world's largest crypto exchanges, share the same CEO, a man named Jean-Louis van der Velde, who operates from the shadows, rarely photographed, never interviewed. They share the same general counsel, a lawyer named Stuart Hoegner, who will become instrumental in the company's legal battles. They share office space, infrastructure, and management. They are, for all practical purposes, the same company operating under different names. This revelation transforms everything. If Tether and Bitfinex are the same entity, then Bitfinex could be using Tether to create artificial buying power, printing tokens without backing them with real dollars, using those tokens to purchase Bitcoin and drive up prices, profiting from the surge, then dissolving the Tethers back into nothing. It would be the perfect crime. Creating money from thin air to manipulate the world's most speculative market, all while operating beyond the reach of traditional regulators. The scheme would make Bernie Madoff look like a small-time operator. Tether's response to these accusations is to promise an audit. They hire Friedman LLP, a respected accounting firm, and announce that full transparency is coming. The crypto community watches and waits. Months pass. Then, in January 2018, as Bitcoin crashes from its all-time high and the entire market begins to hemorrhage value, Tether quietly announces that its relationship with Friedman LLP has been dissolved. No audit will be forthcoming. No explanation is provided. The community is left with nothing but promises and suspicions. What happens next reveals just how deep the shadows around Tether actually run. In April 2019, the New York Attorney General's office files a stunning court document. Their investigation has uncovered something explosive. Bitfinex has lost $850 million. The money was being held by a payment processor called Crypto Capital, operating in Panama, and it has simply vanished. Seized by authorities in multiple countries, frozen in accounts that Bitfinex cannot access, gone into a legal black hole that may never release it. Rather than disclose this catastrophic loss to their customers, Bitfinex allegedly did something far more sinister. They reached into Tether's reserves, the reserves that are supposed to back every USDT token in circulation, and used $900 million of that money to cover their losses. Read that again, because it's the moment the entire illusion threatens to collapse. Tether, the stablecoin that promises dollar-for-dollar backing, allegedly allowed its sister company to borrow nearly $1 billion from the very reserves that give Tether its value. If true, it means that for a crucial period, billions of Tether tokens were circulating in the market, backed by nothing but an IOU from a company that had just lost $850 million. The entire foundation of Tether's stability was revealed as quicksand. Tether's response is a masterclass in corporate opacity. They don't deny the allegations, they can't, because the evidence is too strong. Instead, they quietly change their terms of service. The promise of one-to-one dollar backing disappears from their website. It's replaced with vaguer language about reserves that might include not just dollars, but also loans, cryptocurrencies, and other assets. The digital dollar, it turns out, was never fully backed by actual dollars at all, and the market, incredibly, barely flinches. Tether is too embedded, too useful, too necessary to the functioning of cryptocurrency trading. Destroying Tether would mean destroying the infrastructure that enables billions of dollars in daily trading volume, so the market collectively decides to look away from the abyss. The legal battle with New York drags on for 2 years, a grinding war of subpoenas and legal motions fought in the shadows of sealed court documents. Finally, in February 2021, it ends not with a bang, but with a whimper. Tether and Bitfinex agree to pay an $18.5 million fine and promise to be more transparent about their reserves. They admit no wrongdoing. They provide no detailed accounting of where the $850 million went or how much of Tether's backing actually exists. But they do begin releasing attestations. Not audits, but attestations. A lower standard of financial reporting that provides snapshots of their reserves without the rigorous verification an audit would require. These attestations reveal a financial structure that would make any traditional banker recoil in horror. Yes, Tether holds reserves. But those reserves are a bizarre cocktail of assets that bears no resemblance to what most people imagine when they hear backed by dollars. There are treasury bills and bank deposits, but also commercial paper, essentially corporate IOUs from companies whose identities Tether refuses to reveal. There are secured loans, the collateral for which remains mysterious. There are precious metals and cryptocurrencies, assets whose values fluctuate wildly. And there are other investments that fall under catch-all categories, so vague they could mean almost anything. At various points, less than 3% of Tether's reserves consisted of actual cash. The rest was a constantly shifting portfolio of assets that Tether's executives valued at the same dollar amount as the tokens in circulation, but which might not actually be worth that much if Tether ever needed to liquidate them quickly. Here's where the story takes its darkest turn, because the opacity isn't just about hiding financial weakness. Multiple academic studies emerge suggesting something far more sinister might be happening in the shadows. Researchers at the University of Texas publish a paper examining the timing of Tether's token creation and Bitcoin's price movements during the 2017 bull run. Their findings are chilling. New Tether tokens appeared to flow into the market specifically during periods when Bitcoin's price was falling. And these injections were followed by sharp price increases. The statistical correlation is too strong to dismiss as coincidence. The implication is explosive. Tether may have been used to manipulate Bitcoin's price, printing unbacked tokens during crashes to create artificial buying pressure, driving the price back up, allowing insiders to profit from the surge. If true, it means Bitcoin's legendary 2017 rally to $20,000, the event that brought cryptocurrency into mainstream consciousness, might have been partially fueled by fabricated money. Tether denies everything, threatening to sue researchers and journalists who suggest manipulation. But the questions keep multiplying, and each answer Tether provides seems to spawn 3 new mysteries. Where exactly are Tether's bank accounts? The company admits that much of its banking is done through institutions in the Bahamas, institutions with less regulatory oversight than major global banks. Who are the executives making decisions about these billions in reserves? Jean-Louis van der Velde remains a ghost, his photograph absent from the internet, his voice never heard in interviews. The company's transparency reports show a rotating cast of directors and executives, many with addresses in crypto-friendly jurisdictions where questions are rarely asked and answered. Meanwhile, Tether keeps growing. $1 billion in circulation becomes $10 billion. $10 billion becomes $50 billion. By 2021, as cryptocurrency enters another massive bull market, Tether's printing press runs at unprecedented speed. Some days see 1 billion new tokens created. Some weeks see 5 billion. The printer is running so hot that observers begin to wonder if there's any conceivable way Tether is actually receiving equivalent dollars, fast enough to maintain even their loose definition of backing. Banks don't move billions of dollars in days without extensive documentation, compliance checks, and regulatory scrutiny. Yet Tether seems to materialize billions in reserves with no visible effort, no public banking relationships, no paper trail that outside observers can follow. The people running Tether have become impossibly wealthy from this arrangement, though the exact mechanisms remain opaque. The company charges fees for minting and redeeming tokens, collecting a percentage on the billions flowing through its system. If they're investing the reserves in interest-bearing assets, commercial paper, treasury bills, loans, they're collecting returns on other people's money, potentially billions in annual profit from float. It's the banking model stripped of banking regulation, central bank oversight, or government guarantee. And it's all happening beyond the reach of the Federal Reserve, the SEC, or any traditional financial authority. When asked about their profits, Tether executives provide vague assurances that they're doing well, but refuse to disclose specific numbers. When asked about their reserves, they provide attestations, but refuse full audits. When asked about their banking relationships, they cite competitive sensitivity and refuse to name their partners. Every answer is a door closing, every disclosure a carefully managed reveal that obscures more than it illuminates. The really terrifying part, the reason this story matters beyond cryptocurrency, is what happens if Tether collapses. By 2024, Tether has become the plumbing of the global cryptocurrency market. Over 70% of all Bitcoin trading happens against Tether, not against actual dollars. Exchanges use it as their primary unit of account. Traders park billions in it between positions. Decentralized finance protocols use it as collateral for loans worth tens of billions. The entire $2 trillion cryptocurrency market essentially runs on Tether's rails. If confidence breaks, if too many people try to redeem their Tether for actual dollars at once, the cascade would be biblical. Imagine a bank run, but in the digital age, happening at the speed of light across global markets with no central bank to serve as lender of last resort. Tether holders rush to sell, driving the price below its supposed $1 peg. This triggers margin calls across the crypto ecosystem, forcing liquidations of Bitcoin and other cryptocurrencies held as collateral. Those liquidations crash crypto prices, triggering more margin calls, more liquidations. A death spiral accelerating faster than human intervention can stop it. Exchanges that hold billions in Tether suddenly find their treasury worth pennies on the dollar. Decentralized protocols collapse as their Tether-backed loans become under-collateralized. And somewhere in the Bahamas, in bank accounts that may or may not hold sufficient reserves, Tether scrambles to honor redemptions with assets that may or may not be liquid enough to convert to dollars at the speed the market demands. This isn't paranoid speculation. It's happened before, just on a smaller scale. In 2022, a different stablecoin called Terra USD, which promised dollar stability through algorithmic mechanisms rather than reserves, experienced exactly this death spiral. It collapsed in 48 hours, vaporizing $40 billion in value and triggering a crypto winter that destroyed countless smaller projects. But Terra was a fraction of Tether's size and importance. A Tether collapse wouldn't just hurt crypto enthusiasts. It would ripple through global markets as hedge funds, family offices, and institutions that have exposure to crypto suddenly face catastrophic losses. The wealth destruction would be measured in hundreds of billions, perhaps trillions, and the psychological damage to trust in cryptocurrency might set the industry back a decade. Yet Tether persists, seemingly invulnerable to the skepticism and legal pressure that would destroy most companies. Part of this is structural. They've made themselves too important to fail, at least from the perspective of the crypto market. Part of it is jurisdictional. By spreading their operations across multiple countries and keeping their banking in places with light regulation, they've made it nearly impossible for any single authority to shut them down. And part of it is psychological. The market has decided to believe, or at least to pretend to believe, because the alternative is too frightening to contemplate. The crypto community has developed elaborate rationalization for trusting Tether despite everything. They point out that Tether has always honored redemptions, at least for large institutional customers who go through the proper channels. They note that the company has survived multiple crises: the Bitfinex scandal, the New York investigation, the academic papers suggesting manipulation, and emerged stronger each time. They argue that if Tether were truly fraudulent, it would have collapsed by now under the weight of its own lies. But this logic has a fatal flaw. It assumes that fraud collapses quickly, that lies are always exposed, that justice eventually prevails. History suggests otherwise. Madoff ran his Ponzi scheme for decades before it finally imploded. Enron was the darling of Wall Street until the day it wasn't. The longer a deception runs, the more people become invested in maintaining it, until the line between victim and accomplice blurs into nothing. Recent developments have done little to settle the questions. In 2023, Tether released attestations showing improvement in its reserve composition: more treasury bills, fewer commercial paper IOUs, a marginally more stable portfolio. But still no audit, still no detailed disclosure of banking partners, still no transparency about who exactly is making decisions about over $100 billion in assets. The company has begun fighting back more aggressively against critics, hiring lawyers to threaten publications that question their reserves, funding media outlets friendly to their narrative, positioning themselves as victims of a conspiracy by traditional finance to destroy cryptocurrency innovation. It's a clever strategy. Wrap yourself in the banner of crypto revolution. Make skepticism seem like establishment, fear-mongering. Turn legitimate questions about reserves into attacks on decentralization itself. But beneath the public relations offensive, the fundamental mystery remains unchanged. Nobody outside Tether's inner circle truly knows what backs those tokens. Nobody can verify that the reserves exist in the forms and amounts claimed. Nobody can audit the relationships between Tether, Bitfinex, and the web of related entities that share management and infrastructure. The world is being asked to trust a company that operates from the shadows, has repeatedly changed its story about backing, was caught lending reserves to its sister company, has never submitted to a real audit, and has made its executives wealthy beyond measure, while revealing almost nothing about their operations. Its trust built on nothing but the fear of what happens if that trust breaks. The regulatory noose is tightening, slowly but inexorably. The United States is developing frameworks for stablecoin oversight that would require full audits, transparent banking relationships, and regulatory approval. Europe's MiCA regulations demand similar transparency. If these rules take effect, Tether will face a choice: submit to real oversight, revealing whatever lies in those shadows, or withdraw from major markets and accept diminished relevance. Neither option is appealing for a company that has thrived specifically because it operates beyond oversight's reach. And if Tether chooses to fight rather than comply, the confrontation between this shadow bank and global regulators could become the defining battle over cryptocurrency's future. There are lessons here, dark lessons about power and money and the systems we build to channel both. Tether exists because traditional banking failed cryptocurrency, closed accounts, refused service, made it impossible for a new financial system to interact with the old one. In that void, something had to emerge, and what emerged was a company willing to operate in the shadows, asking for trust while providing no basis for trust, promising stability while building on quicksand. It's a perfect example of how financial innovation can outpace regulation, how companies can exploit jurisdictional gaps to operate beyond any single government's control, how markets can convince themselves to believe comforting lies rather than confront uncomfortable truths. The story also reveals something about risk and collective delusion. Everyone in cryptocurrency knows Tether is questionable. The doubts are not secret. The controversies are not hidden. Yet billions continue to flow through it daily because each individual participant has decided the risk is worth it, that they'll be fast enough to escape if things collapse, that somehow they'll see the crisis coming before everyone else does. It's the psychology of the bubble, the madness of crowds, the belief that you can dance close to the fire without getting burned. And maybe they're right. Maybe Tether really does have sufficient reserves. Maybe the critics are wrong. Maybe this shadow bank will eventually emerge into the light and prove its legitimacy. But maybe not. And the difference between those two possibilities is the difference between continued prosperity and catastrophic collapse for the entire digital asset ecosystem. As of now, Tether stands at over $120 billion in circulation, backing nearly every major cryptocurrency transaction on Earth, operated by executives who refuse interviews from jurisdictions chosen for their lack of scrutiny, with reserves attested but never audited, promising stability built on a foundation that nobody outside the company can actually see. The printer keeps humming in that Hong Kong tower, creating billions in digital dollars with keystrokes and code. Each new token, a promise that somewhere, in some bank account, in some form, an equivalent dollar exists to back it. The market has chosen to believe that promise, or at least to act as if it believes, because the alternative is too terrifying, and the profit potential too seductive. But in the deepest hours of the night, when trading volumes thin and the market pauses to catch its breath, you have to wonder what those executives know that the rest of the world doesn't. You have to wonder whether they sleep well, managing this delicate house of cards, or whether they lie awake calculating exit strategies and contingencies for the day when questions become demands, when attestations aren't enough, when the market finally insists on seeing what lies behind the curtain. You have to wonder if they're financial innovators who solved an impossible problem and get no credit for their brilliance, or if they're the architects of the greatest financial time bomb ever constructed, counting their wealth while the fuse burns shorter. And you have to wonder which version of the truth the world will eventually discover, and whether that discovery will come peacefully through transparency and reform, or catastrophically through collapse and contagion. The printer hums in the darkness, patient and relentless, turning code into currency, promises into power. Every token it creates is a bet that the shadows can hold, that questions can be deflected, that trust can be manufactured from opacity rather than earned through transparency. And so far, impossibly, that bet keeps winning. But in the world of money and power, the bigger the illusion, the more catastrophic the awakening when reality finally breaks through. The only question is whether Tether is the future of finance or its most dangerous fiction. And the only certainty is that nobody outside that Hong Kong tower truly knows the answer. Subscribe and listen to our next story below.